Capitalist Show. One of my favorites, a good buddy of mine. You all know who he is. He needs no introduction whatsoever. His name is Brent Johnson. Brent, welcome back to the Rebel Capitalist Show.
Happy to be here. Thanks for having me.
All right, buddy. Now, you just had an amazing interview on Real Vision with Lynn. So I want to get into that first and foremost. So if you could articulate her side of or her opinion on how she sees this playing out, and then kind of tell us where you stand, and then maybe the differences that you guys had.
Sure. Well, I never really like speaking for somebody else, so I'm going to kind of paraphrase what she said, but don't hold it against me if I get it exactly wrong. And, I defer to her on her own opinions, of course. I mean, I think essentially the difference is that we have identified many of the same issues. Mm-hmm. And I think what it really comes down to is that she believes that the central bankers and the monetary authorities will be able to handle it much better than I do. I have less faith that they will be able to recollateralize the rest of the world with dollars than she does. And I think she also believes that a number of countries around the world will continue to continue in their de-dollarization efforts and have some success there. And then the third thing is I think, and I hope I'm not changing her words, but I think she thinks that the U.S. will willfully, give up some of its dollar dominance around the world and have it become less of a, she's not saying they're giving up the global reserve, but she's saying it will at the U.S. behest, it will be used less and less around the world, and therefore alleviate some of the dollar pressure, and therefore the dollar will fall, and the whole world will kind of continue on in this quasi Rube Goldberg type monetary system.
Right. Okay. So as far as the United States not wanting or not willing to give up the reserve currency status makes a lot of sense. I actually did a video today where I addressed this briefly. And what I was looking at was, okay, if the United States allows the dollar to continue to go up and up and up and up, assuming they have control over it, but if they did that, then I think, and I don't know that they're this smart to even see this far ahead, but if they were, they'd say to themselves, okay, this is kind of like giving like a dollar a PTSD type thing, where these countries, once they get done out of this mess, however long it takes, the phoenix rises up from the ashes. They're like, listen, this dollar thing, we did that once. We want nothing to do with it now. So if you're the United States, are you saying, okay, we want a strong dollar because we want leverage over these countries going to the swap lines, and we'll get to that in a moment. But so we like kind of a strong dollar, but we don't want it too high because we don't want to prevent these countries from potentially abandoning it in the future when they have the option. Do you think they're that smart, or they think that far ahead?
I think there's a few people that are that smart, but I think as a whole, the government is that smart. I mean, I think there's a lot of people in the government that just don't have any clue. And there's probably a lot of people in power that don't have any clue. And there's probably, I know for a fact that there's government agencies that are studying this right now, because friends of mine have been contacted by these agencies, and I've been contacted by these agencies. Really? So I know that they are. That's cool. I know that they're studying this issue. I know that they're absolutely studying this issue. And, the points that they've made to me is that the people that they're doing this work for, they don't really know what the hell's going on. And that's why these guys are researching it for them. And again, I've always said, are central bankers people who really mean it? Are they idiots who really mean it? Or was a smart people who are putting us on, or idiots who really mean it? And I've always said that at the top, I think the central bankers, I think they know what they're doing. They may play dumb, but I don't think that they're stupid people. Yeah. And so they may be misguided, but they're not stupid. And so I think that this problem, this euro dollar problem, or this lack of dollar supply problem, that I think the cat's kind of out of the bag on it. Maybe 2 years ago, they weren't quite aware of it. But I think the cat's out of the bag on it now. And so now I think the main question for me is, what can they do about it? And do they have theoretically, there's a lot of things they can do, but can they put those things that work in theory into the real world and have it go smoothly? I don't think that they can. The other side thinks that they can.
See, that's a great point. And a lot of people see all of this money printing in the United States, whether it's quantitative easing or going back to March, this unlimited repo that they're committing to, or the government just deficit spending to oblivion. But what they don't think about is the transfer mechanism for those dollars to get outside of the United States. And going back to this video I did today, I went through the swap lines because I thought that was interesting. And if you look at the way the swap lines are done, let's just take the Bank of Japan as an example. The Fed, they have an account with the Fed. And the Fed just increases dollar bank reserves for the BOJ. And then if there's a bank in Japan that needs, let's say they've got someone to lend to a corporation that needs dollars for the dollar denominated debt, then the bank in Japan, not the Bank of Japan, but that Japanese bank accesses the reserve account that's at the Fed. And then they take those dollars to back up the reserves to create the additional loans. But the whole thing is if it's all a cash flow issue. So if the entities are insolvent, the banks themselves aren't going to create that additional supply of dollars. And if you read what the Fed says on it on their website, at the end of the day, the Bank of Japan is holding the bag. They're the ones liable for the dollar denominated debt. So so you've got the money that's stuck at the Fed, and the transfer mechanism is the commercial bank. But why on earth would they lend it? And if they don't lend it, it stays at the Fed.
Yeah, and not only that, this is one of the other things that I've been trying to explain to people is we're not just giving those dollars to them. They have to pledge yen for it. But where do they get the yen? Well, they have to print the yen. So it's not like we're the only ones printing. It's not like the dollars are the only currency that's being printed to extend the swap lines. The other currencies have to get printed as well. So, this idea that we're going to print and print and print and the rest of the world is not, and therefore the dollar is going to fall, it's fallacious to begin with. And it doesn't even take into account the other side of the equation, which is supply, which is demand. All of this argument about the Fed doing QE and it's going to hurt the dollar, theoretically it's correct, but it's always focusing on the supply side. It never takes into account the demand side. And the demand for the dollar eclipses any other currency in the world by a major multiple. So the idea, that just because we're printing that the dollar is going to lose value it's just wrong. It just is. The last 10 years, the United States monetary base has gone up 10 times, 10x over 10 years. And what has the dollar done over that time period? It went from 72 to 100. So right there, it's just incorrect to say that the dollar will fall. Now, people will say it's fallen against real goods. Fair enough. Fine. But as far as versus other currencies, it hasn't. It's actually gotten stronger.
Yeah, it all goes back to people looking at the dollar as two completely separate currencies. At least that's what I suggest doing. You've got to look at it as a domestic currency and an international currency. And those two things can be going in opposite directions quite substantially, really. And so let's talk about if these entities, let's say they've got dollar denominated debt, they get the dollars and then they pay back their debt. But if they're paying down the debt, it's reducing the amount of dollar supply that's outside the United States in the system if the debt was originally taken on by a bank. So, and I kind of tried to think through this, and tell me if I'm wrong here, but if they originally got the debt from a non-bank, then if they were to pay it off, theoretically, that wouldn't reduce the amount of dollars in the system. Am I seeing that right?
That's correct. Yeah, that's correct.
Okay. So how much of this is nuanced in the sense that we've got to try to figure out if we're trying to figure out if the dollar is going down or up, or the money supply outside the United States is going up or down due to the debts being paid off, how detailed do we need to get in our analysis to figure out how much of that debt was bank and non-bank?
Well, it would certainly, I don't know if that information is available. Maybe it is. I haven't seen that level of detail. It would help to know that. But my point that I like to make is that it matters to a certain extent, but in the bigger picture, it doesn't, because it does. This is when money is, it doesn't matter if it's the United States or if it's the Brazil or Japan. When money gets loaned into existence, and it gets loaned into existence with interest, the money supply always has to grow, because there is never enough money to pay off the debt. So the money has to be circulating fast enough to pay the interest. Otherwise, it's a house of cards that will come crashing down if it doesn't continue to grow.
It's all about velocity.
It's an exponential system has to continue growing. or there has to be enough velocity to pay the interest. If it doesn't happen, if it doesn't keep growing, it's like a pyramid scheme. Pyramid schemes have to keep growing or else they crash. And the point is that outside the United States, credit is contracting. It's contracting in the United States as well. That's the whole reason that the Fed has had to come in and do QE. They are recollateralizing the system because the collateral is collapsing, or the amount of equity in the system versus the amount of debt is collapsing. It's just like when you buy something on margin and you borrow to do it and the stocks go up, it's no problem. But as soon as those stocks start to fall, when the equity in the account starts to fall, you have to pledge new collateral. You have to put new money in the system to recollateralize it to bring it back into balance. It's the same thing with the monetary system. The problem is that when credit is, there's only two ways that money gets created. Either the Fed prints it literally, or the Fed injects it, or I guess there's three ways. The Fed injects it, the Fed prints it, or credit is extended. Most money in the system is made by central banks, by the extension of credit, by making new loans. Loans create deposits.
Right.
But when that reverses, there's no, when the credit is extended outside the United States, that's how money is created outside the United States. But there's no entity outside the United States that can recollateralize the system outside the United States when that flow reverses. There is no entity that can inject new capital into the euro dollar system. That's why they had to go to the Fed to get the swap lines to do it. And right. I think the point, the point that I would make is the reason that the foreigners had to tap the swap lines, not so much because they wanted to make new loans, but because the old collateral was collapsing. You know, they're having a credit contraction. You know, defaults are starting to happen. Payments aren't getting made. So it's not like the Bank of Japan called up, you know, the Fed and said, hey, we have incredible demand for new loans. Mm-hmm. On top of it. Basically, they needed new funding to paper over the old funding. Does that make sense? They're trying to roll the loans that already exist, and they're not getting rolled because credit is contracting. So a lot of this money that's going there, I keep trying to explain to people, in a credit contraction, the injection of new capital is not really increasing the overall size of the money. It's just trying to fill a leaking bucket. It's just trying to keep the bucket. It's trying to keep everything from leaking out. It's trying to keep the bucket full. But you've got to pour more capital in than that's being destroyed.
And it goes back to being a cash flow issue.
It's a cash flow issue.
If you don't have the cash flow, you kick the can down the road. Exactly. But at a certain point, you know, the example I use today is someone making $4,000 a year, just your average person, $4,000 a month. Right. And let's say they've got a massive amount of debt. So they have $3,500 a month in debt payments. Right. Well, they only have $500 left over. If their car breaks down, or they have this $1,000 accident that comes up, yep. and a new bank comes in and says, we'll give you 10 grand. So now all of a sudden you don't have liquidity issues. You can pay off your existing payment and yep. to the mechanic or whatever. Well, now you've got another $500 a month, let's just say, yep. of debt payment. And now you have zero cash flow. So how are you going to buy food? So that's the only solution there. Isn't more and more debt, even though it gives you some more, let's call it liquidity, but it's you need more income. And it's the exact same thing here. Yeah.
And that's, you know, the Fed can make banks and companies and stuff liquid for a little while, but they can't make them solvent.
Right.
They can't make them be good businesses. They can't make them be a going concern. And, you know, when the short-term injections run out, you're right back where you started. And these swap lines, I get into this argument all the time with people. The swap lines are reinforcing the dollar as the global reserve currency. They're not solving it. They're reinforcing it. Because until there's another system that everybody can go to, dollar debt is demand for dollars. Right. And the extension of swap lines extends dollar debt. It makes the problem bigger. It doesn't solve it.
Yeah. So, and you know, even if the swap lines are used.
That's even if the swap lines are used. Exactly. Especially if the swap lines are used, because they're extending more dollar credit, which increases more dollar demand from the same level of assets that you were just talking. It's like, you know, now they've got a bigger debt payment to make on the same amount of revenue.
Yeah, but less dollar income potentially now, because we got the cerveza sickness, we've got the the deglobalization, and
Yeah.
just for the viewers so they
Yeah.
understand what we're talking about. Typically, the transfer mechanism for dollars getting outside of the United States into the global system. So again, we're talking about the two different dollars, the domestic dollar and the international dollar, and then a supply demand equation there. So normally that's through trade. So if the United States runs a trade deficit, that means we're importing more goods. That by definition means we're exporting more dollars. But if global trade, due to whatever, especially now we're in a global recession or maybe even depression, that shrinks and shrinks and shrinks. Plus, you have deglobalization, where everyone wants to bring those supply chains back to the United States.
Right.
Again, that's fewer and fewer dollars or income going out to service a greater and greater amount of dollar-denominated debt, even if the swap lines are working.
Right. And that, I think this is part of my argument against the dollar bears case, is they say, all of the foreigners the foreign countries have these great trade surpluses, and, they run budget surpluses rather than deficits. And, they're looking at the last 4 years. But if the U.S. is going into a big recession and we're their biggest customer or their top two customer, then you can't project those past 4 years numbers the same way that the next 4 years are going to be. So the idea that the U.S. is going to go into this massive recession and the rest of the world is going to be just fine because they have these great trade statistics is just, it just frustrates me to no end to even have that argument. It's silly. It's completely silly.
Yeah. I think really, Brent, what most people get stuck on is they just see the amount of money that the Fed prints and they just say, how can this not decrease the dollar relative to other currencies? And they just get stuck on that the whole time.
I sent something out a week or so ago, and it was a picture of Plato's. Plato had this theory of the cave where people were chained in a cave and they're looking at the wall and there's a fire behind them. And there's figures, behind the fire, and it projects their shadows up onto the wall. And that's all they know. All these people know is the shadows on the wall. That's the whole world to them. They don't know about the real world that's behind them. And that's kind of my view of the people that focus on the Fed programs and the supply of dollars and think that they understand everything. It's only a small part of the overall equation. They're focused on the shadows and they don't understand the real world. Yeah, we're printing a lot of currency, and it's going to get a lot more than we've printed now. If you think we've printed a lot now, just wait a year or two.
Yeah.
But it's not even half of the overall equation. And so it just, that's fine. They're doing good analysis on the dollar. They're just not looking at everything else. And I think they need to look at everything else as well.
Yeah. To me, in my mind, it just goes back to how did the dollars, no matter if you could print a quadrillion and stimulus checks, MMT, UBI, but how does that get out of the United States to lessen the demand for dollars? And going back to that supply demand equation, it's if the Fed could somehow do international MMT, well, now we got a ball game. If they could somehow send stimulus checks, let's say, to all of these other corporations outside the United States, well, now all of a sudden you've got those dollars getting out there, and it could be a reasonable argument. But I don't know how the heck they would do that. Obviously, politically, it's unpalatable. But
I don't think politically they'd be able to do it. However, let's pretend that they are, because a lot of the people that argue against my theory says the Fed will provide however many dollars are necessary, because if they don't, it'll eventually come back and it'll crash the U.S. system as well. And my point is, I agree with you that this is going to end horribly for the United States. But if you think it all the way through, logically think it through, and the progression that would happen for it to come back and kill the United States, many other countries will fall before the United States falls. And that has been my argument the whole time. This is going to end incredibly bad for the United States. Bailing out the rest of the world. If they don't bail out the rest of the world, the U.S. system will fall. That's part of my theory. The U.S. is going to fall. But before it falls, all of these other countries are going to fall as well. And
because we're their number one customer. Is that
because we're their number one customer, and they all need dollars to operate. There's no other system to go to. So until they all agree at the same time to go to this other system, this is the progression. And so it'll end really badly for the US and the US dollar, but it'll end really badly for other countries and their currencies before the US and the dollar. So
Yeah.
I don't have a problem with the people that say it'll come back and it'll hurt the US. Of course it will. It's a Ponzi scheme. The whole system is a Ponzi scheme. But everybody's running Ponzi schemes. We're not the only one running a Ponzi scheme.
Yeah.
And so, you know, and a lot of people don't like that terminology, at least in the professional world or, you know, official Wall Street circles, but it essentially is.
Yeah, for sure. Well, there's no one that watches my channel that has an issue with the term Ponzi scheme. I can tell you that for sure.
Yeah.
So one of the things you talked about, and I mentioned it right at the beginning with Lynn, is how the United States may try to weaponize the swap lines. Can you go into that a little bit?
Yeah, this is something I've been talking about. So we were expecting swap lines to be extended before they were extended. We knew that the dollar would become a weapon or a tool that the U.S. would use. And you know, it's funny. I think it was right around the same time we did our last. I think we did our last interview in March, right around the height of the kind of current crisis, or maybe shortly thereafter.
Yeah.
But literally, like on March 19th, I sent out a tweet because, you know, as the dollar's going higher, of course, I was getting a lot of messages, a lot of phone calls, emails saying, hey, this seems to be going our way, and, you know, the dollar's running, and it was, and, you know, and I continue to think it's going to go higher. But I sent out a tweet on the 19th of March that said, for everybody new to this whole dollar game, especially if you're new to the dollar bull camp, just be careful, because at some point the Fed's going to come out and they're going to do something, and they're going to provide the liquidity that's necessary, and the dollar's going to fall, and it's going to hurt. If you're a dollar bull, it's going to hurt. That's exactly what's happening. That's exactly what they did. You know, they came out with swap lines, extended the swap lines, and, you know, they flooded the market with liquidity, and the dollar's pulled back. Totally expected, not shocked at all. But they've not solved anything. So, you know, whether it's 3 days from now, 3 weeks from now, or 3 months from now, I have no doubt we're going to hit that again. But let's go. But to the swap lines, the point that we've been trying to make is, yes, we will provide swap lines to people who help us. But we are not going to supply swap lines to people who are trying to hurt us. It will be used as a geopolitical tool. And we will provide them. We may provide them, assuming that you provide something else for us. It'll be a quid pro quo. It's not just going to be out of the goodness of our hearts. And it's not going to be just because we don't want them to sell our U.S. assets or assets denominated in U.S. dollars. Turkey is the most prominent example. I sent out an article earlier today or yesterday that talks about how Turkey has been begging for a swap line because they have huge amounts of U.S. dollar funding needs. They have a large amount of U.S. dollar debt. A lot of their business gets done in U.S. dollars. Trade finance gets done in dollars. They're having a really hard time operating without U.S. dollars. The problem is that, you know, Turkey's also played this geopolitical game, trying to play the U.S. against the Russians, and, you know, they're our friend 1 minute and they're Russians' friends the next. And you know, a year ago they bought a lot of these Russian missiles as a defense system. But, you know, we're not going to give them a swap line as long as they're still using those Russian defense missiles as part of their defense system. Now, if they were to say, you know what, we're not going to use this Russian defense system, and we're going to send these missiles back to Russia, or anti-tank missiles, or, you know, I think they're the SAM 300s, I think they are. Well, in that case, then, you know, we might give them a swap line. But I think that's how it's going to be used. You know, we'll help our friends, but we won't help. China's not going to get a swap line unless they make some concessions. Russia's not going to get a swap line unless they make concessions. Some of these other countries who aren't doing what we want them to do aren't going to get a swap line unless we want them, unless they give us something in return. And I think this is just getting started. You know, so far the countries that have received swap lines are our allies. You know, Japan, Australia, Brazil. You know, the ECB. I mean, it's largely quote unquote Western nations, with the exception of Japan, that you know, are kind of on the U.S. block, for lack of a better word. But I think this is going to be a huge issue over the next couple of years. This isn't the last you've heard of swap lines. Yeah,
for sure. And then to take it to the next layer, you got to figure out, okay, well, Turkey or any other country, does the sovereign need the dollars, or does the private sector need the dollars? Is it both? Because that really plays into it. One thing I noticed today when I was reading from the Fed's website is technically the swap lines are kind of like repos, where they're from overnight to about 3 months. Now, I think, of course, they could most likely roll them. But what I was trying to think through is, let's say you get a 1 month swap line, or you do the transaction. Well, a month from now, you still got to come up with $1 trillion. So even if you use it and spend it, well, now where are you going to get the trillion to refund the swap line account back at the Fed or wherever? I mean, how does that work out?
Well, that's the thing is that, I mean, all of these foreign central banks are getting these dollars to lend them to companies who are insolvent. They're not all insolvent, but many of them are insolvent, or else they wouldn't be looking for new dollar financing, right?
Right. It's as if their cash flow will improve somehow.
Exactly. So if the idea is that we're going to send them, U.S. dollar liquidity, and magically the management team is going to institute these major changes, and all of a sudden global growth explodes, and and then they have these fantastically profitable businesses. Yeah, sure. Then under that scenario, I'm completely wrong. I just don't think that's going to happen. I think they're making the problem bigger. And yes, can the swap lines get rolled? Of course they can. Theoretically, can we provide 10 trillion to the rest of the world via euro dollar swaps? Sure, we can, theoretically. Politically, I think it's a little bit difficult to do, but I can't say it's impossible. But if we print 10 trillion, they've got to print 10 trillion as well. It's just the way it works.
Yeah. So let's talk about the TGA. I know that you addressed that with Lynn. I did a video on it. Just really fascinating.
Yeah. I got to tell you, George, I don't have an answer. I wish I did. I'm trying to figure it out. Typically what happens, and part of the reason that we have been arguing for the dollar to go higher, is we knew the Treasury was going to come out and, they were going to issue a lot of dollars. And this was forecast last year that they were going to, issue this many treasuries. And at the time we weren't doing QE. And our argument was like, if they don't do QE, the dollar's going to go through the roof when the Fed or when the Treasury comes in and buys this many dollars from the market. Now, what they've done is they've issued a record amount of treasuries in the last, call it 3 or 4 months, coincidentally while the Fed was monetizing it. But it's not the dollar pulling back and the Fed doing QE. That's not the only issue here. The other part of it, we were expecting them to flood the market with QE. We thought that would be in response to the fact that dollars were no longer flowing, mainly due to COVID, right?
Okay.
The market was already slowing down. COVID exacerbated it. Dollars weren't circulating. We get into this dollar squeeze, so that we thought the Fed would respond by providing liquidity. They did. But what we did not consider, and what we got wrong, was that because trade is not happening, invoices aren't being paid. So a lot of dollar payments have been deferred. Rents, mortgages, things like that. If you call your bank and you say, I've been affected by COVID, can I have a deferment of my mortgage for 3 months? Well, a lot of them will say, yeah. Same with rents, right?
They'll give you 9.
They'll give you 6. They'll give you 9, right? But those payments, they're not forgiving the payments. They're deferring the payments, right? And so we didn't really think that's something that we missed. And so they're flooding the market with dollars at the same time that dollar payments aren't needing to be made. And so our argument is that when trade starts, and then not only that, but like cross-border trade, if you order $1 million worth of inventory from China and they don't ship it, well, then you're not going to send them $1 million either, right? Mm-hmm. So a lot of times you do trade finance and you have 30, 60, 90 days to pay the invoice.
Right.
Well, if you haven't received your inventory yet, you're not going to pay the dollar. So when trade starts happening again, when the markets open back up, and when these deferred payments actually start coming due, which will now be bigger because they've been adding up, right? It's not like you just have to start making your monthly payment again. You have to make 4 monthly payments or 5 monthly or whatever it is when the payments start again. So when that happens again, and when trade finance invoices start getting paid, we think that the dollar shortage will reemerge.
Okay, so let me just kind of unpack that.
I think I went off on a tangent there, so I don't know if I answered your question or not. But
no, we'll circle back to the TGA, but I want to see how that plays out before for the election. But let's unpack that just for a moment, Brent, to make sure everyone's following along with the conversation. So basically, what you're saying is we have a lot of these corporations that are purchasing goods from, let's say, China. and they're planning on it. So therefore, dollars would get outside of the United States, but they've postponed that. So it's basically like an individual person. You have to pay rent every month to your landlord. But he said, okay, just don't pay me for 4 months, but you still owe him the 4 months of rent. It's just you're going to pay him all at one time in 4 months. So basically, what the U.S. corporation has done is saved all of those dollars. And it's not like they're not going to pay, let's say China or Japan or whatever. They're just they're postponing doing that. So all those dollars are being collected inside the United States domestically. But at some point in time, they're going to leave. Am I getting that right, or am I getting it reversed?
Well, that is correct, but that's just part of it. But there's also, dollar financing that takes place outside the United States. If Turkey trades with Egypt, there's a very good possibility it's done in dollars. Or if Brazil trades with Japan, it's very possible it's done in dollars. I guess my point is in a lot of dollar trade, cross-border trade finance, however you want to describe that, has been deferred. But when markets open back up, whether that's, again, 3 weeks or 3 months or 3 years from now, when it opens back up, those dollars are still going to be owed. And they're going to, and when people actually have to start making their dollar payments, this dollar shortage is going to reemerge.
Okay. So the dollar shortage outside, when people have to make their oh, I see what you're saying. Got it. So the creditors outside the United States that are owed the dollars, they're allowing them to defer payments. But when the 4 months is up, or at some point in time, they're going to say, okay, now it's time to pay the fiddler. And now they've got 6 months of back payments that they owe, which increases the amount of dollar demand at that specific time, because it's kind of backlogged.
Right. No, exactly.
Okay, great. So we got that. Now let's go back.
That goes to the Treasury. Going to the Treasury. So
so
the fact that the Treasury issued all this debt at a time when the Fed was basically monetizing it. No, they didn't monetize it directly. They go through the primary dealers, but everybody knows that the debt's being monetized. It's being monetized. I mean, it's being monetized in Europe. It's being monetized in Japan. It's being monetized. It's everywhere is monetizing the debt. They dress it up and they say they're not doing it, but they're doing it. And at the same time, the government has not spent the money yet. And I think a lot of it has already been earmarked, but I think a lot of it will be spent in Q3. But they won't spend it until the money that hasn't been authorized, the Congress is going to have to vote on a spending bill or a stimulus bill or whatever. Now, typically, when that money gets spent into the market, that's bad for the dollar typically. So it'll be really interesting. So that's something I'm watching pretty closely. It'll be interesting to see the timing with which they start to spend that money. If they start to spend that money at the same time that the Fed is doing a lot of QE, and if there's still a lot of deferment of payments, then I would expect to see further dollar weakness in the short term. But you can't keep the economies closed down forever. And when the economies open up again, and when trade starts happening, and when payments have to be made, I fully expect the dollar to rally hard.
Yeah. So just to give some context to what we're talking about for those people who might not be familiar with the TGA, which is the Treasury General Account. This is basically the bank account for the government, really.
Right. Exactly.
And so when they collect,
it sits at the Federal Reserve.
Yeah.
It's the Treasury's checking account.
Yeah, you got it. And I won't go into it, but prior to 2008, it was actually in the commercial banking system, and then they moved it to the Fed, which basically gave the Treasury the ability to do QE or QT. If you look at QE as just simply increasing bank reserves in the system. So generally, that's a interesting word to use in these day and times. But prior to 2008, that TGA would fluctuate between $2 and $5 billion, billion with a B. Yeah. And now they've allowed it to grow up to 1.5, almost probably maybe even 1.6 trillion right now that can be spent, boom, into the economy.
I don't think it has all been authorized yet, but yes, it can be. But as I said, typically what happens is when that balance typically stays between 100 billion and 400 billion. Like you said, 10 years ago it was 2 or 3 billion, and now it's typically between 75 and 300, or a couple $100 billion. But it's up to 1.5, 1.6 billion.
Trillion.
It's amazing. I'm sorry, trillion. Yes, trillion. Sorry. Yeah, and
Yeah.
it's kind of an amazing. And so there's actually been some, at one point the Treasury puts out forecasts for what they think their balance will be, and at one point they put out an estimation that that at the end of the quarter their balance would be 800 billion, which would mean they've got 700 billion to spend. Now I can't remember if it was at the end of calendar Q2 or their fiscal Q2.
Right.
But the point is that money is going to get spent, and that's going to be another flush of cash that comes into the system.
And to be clear, that doesn't just increase bank reserves. So if the Fed did QE, I don't think they've ever done 700. Just to give people context, again, QE3, the Fed is doing about 80 billion per month. So think about 700 billion in the matter of a month or something like that. But the big difference there I want to point out for people is when the Fed does it, it just increases the bank reserves that are held at the Fed. But if the Treasury does it, it not only increases the bank reserves in the system, but it also directly increases M2 money supply because it goes into deposit accounts. So the money supply can increase 800, meaning the broad money in the real economy can increase by 800 or 700 billion within the matter of a month. I mean, that is staggering.
Yeah, the next 6 months are going to be fascinating.
Yeah. I mean, how do you see it playing out? Well, how do you see how can I phrase this question? How do you see inflation as far as consumer prices in the United States playing out over the next 6 months compared to the dollar outside the United States compared to other currencies?
It's a really tough question over the next 6 months. I am of the belief that deflation is still the primary driver.
Even in consumer prices?
Yeah, I think so.
Okay.
I think so. Now, can I be wrong? Of course I can be wrong. Well, and I guess, I would lean towards deflation. I understand completely the inflationary argument, and when this money gets spent, it pushes up prices. But I still think, again, a lot of the reason that the Fed is doing QE and the reason that the Treasury is doing these stimulus plans and sending out checks is because the primary force is deflation. They're fighting deflation. The question is, are they going to be able to beat it? The only way you're going to get deflation is if they are able to beat it, and if they're able to spend enough to push prices higher. Maybe they are. I still think that they're trying to fill a leaking bucket, and I think that more capital is being, dissolved or destroyed than is being created.
Yeah. Now, Brent, I know you're short on time. I really appreciate you spending this much of your precious time with us. But one topic I wanted to just address, because I don't think it's something I've ever heard you talk about, but I think it's something crucially important for the average investor that they just never, ever consider. And that is, number one, portfolio construction. And then number two, money management. In my comments and on my Twitter feed, everything, people they're like hyper focused on, is this asset going up or down in price? That's it. Yeah. That's 99% of their analysis. And but then they look at, well, I'm going to buy this because I think it's going up. I'm going to buy this because I think it's going up. But they don't really ever consider how those two assets play against each other when they're in a portfolio. And then the question becomes, okay, do you buy 5% of your portfolio? And do you go 1%? Do you go 50%? Just what do you do? And then number one, when do you sell? When do you buy? How do you control that? And then lastly, I think, how do we get emotion out of the equation? Because people think that, like, let's say they're bullish gold. Well, they just think when they buy it, it's going to go up in a straight line. Well, nothing ever goes up in a straight line. So how do people handle the fact that it could go up, but then it could come all the way down? It could go back. It could go lower. than when you purchased it, and it could go all over the place. Like, how do we get emotion out of the equation? And from a professional standpoint, like, how do you do that? And how important do you think the all the other stuff is outside of just determining if a price is going to go up or down?
Yeah. Well, the reality is most people don't handle it very well. So you say, how do people handle it? They don't. You know, I'll give you a good example, because I'm sure a lot of people want to hear me talk about gold. Gold's a perfect example. Like, I have owned, a large percent allocation. It's fluctuated a little bit over the last couple of years, but I've had a large allocation to gold for 10 years. Mm-hmm. And people think that when I say I think gold's going to fall, that it means I'm selling gold or I'm shorting gold. No, it doesn't. It just means that I'm not expecting that part of my portfolio to pay off right then. If it does, great. Like, the last year is a perfect example. I didn't think gold was going to break out a year ago. It broke out almost exactly a year ago. I didn't think it was going to. I got it wrong. Who cares? I already own it. I didn't lose any money on it, right? It actually helped me I was wrong, but it didn't hurt me. And so, I think if you are open to volatility and you want to play the swings and go all or nothing from asset class to asset class to asset class, then great. Just be ready for the volatility and realize it could go against you. But if you want to create a portfolio, a diversified portfolio that has staying power over a period of months or years or even decades, well, then you don't want everything going up at the same time, because then everything's going to go down at the same time. Mm-hmm. If you have a portfolio and you meet with your investment manager, the first question you should ask is, where are we making money? And hopefully they'll point to a few places where you're making money. Your next question should be, where are you losing money? And if you're not losing money anywhere, that should actually lead to another question. Mm-hmm. Is that, well, are we not diversified? Because right. If you have a diversified portfolio that's ready for anything, you should be losing money somewhere in it. Mm-hmm. Now, most people can't take that. Most people think that's stupid. And even some of my clients make that comment to me, and I always try to bring them back and kind of manage expectations. Say, listen, if you want me to try to just play all the swings and go all or nothing from asset class to asset class, sure, we can do it. It's going to be extremely volatile. We're not always going to get it right, and you're going to have to be able to withstand the drawdowns when it happens. And so I always guide them that, gold. I think gold is the perfect example of this. Yeah. And I would say that my strong dollar allocation, for lack of a better word, is another perfect example. We have a fund that's playing this strong dollar thesis, and then we think there's a lot of knock-on effects. Now, we're not telling people to put 100% of their portfolio into this. It's a very volatile structure. It's going to do very well at times, and it's going to do very poorly at times. But it's a hedge. If we're right, the hedge can become a huge part of the overall portfolio. But if we're wrong, we lose a little bit, and the rest of the portfolio does fine. But to your point, it's all about portfolio construction. If you can, you're never going to get everything right. Right. You're just not. So the trick is to make money when you're right and not lose too much when you're wrong. I'll give you a good example. The last month has been among the most frustrating months in my history. And that was after 4 or 5 months of my best 4 or 5 months in history. At the beginning of the year, through April, or actually through the beginning of May, I probably felt like I had my hand on the markets as well as any time I'd ever had. I was ready for the pull down in Q1. I was ready for the rebound at the bottom in March, and we got aggressive at the bottom and we came up. But then I hedged everything again in the middle of May, because I thought we were at a level for a second pullback, and the market ran another 15% higher from there. And so, we didn't make any money over the last month. That's frustrating and it sucks, right? Mm-hmm. But it's about, it didn't hurt. It didn't help us, but it didn't really hurt us either, because, we'd done well in the first quarter. And we'd done okay at the beginning of the second quarter. But and we got it wrong for the last month, but we didn't lose a lot of money in the last month. Do you see what I'm saying? So when you get it wrong, you just don't want to get killed when you get it wrong. But it doesn't mean it's not frustrating. It doesn't mean it doesn't drive you crazy, but you just kind of got to understand, if you want a diversified portfolio and you're talking about
non-correlated assets,
non-correlated assets, take some big risks with a small percent of your portfolio, take a low level of risk with your big part of your portfolio. And, if you get the overall asset allocation right, you should be okay. But you have to be, there's usually once or twice a year where there's a time for you can make a lot of money. And that happened in March this year. Mm-hmm. It happened in December of 2018. when you see these big opportunities, that's the time to bet big. It's hard to do, but like right now, to me, is not the time to bet big on the equity market. It doesn't mean that the equity market won't go higher. It just means that the time to bet big on the equity market was March, not now when we're back at the highs.
Right.
I don't know if I'm answering your question or not,
No,
but
you
I'm trying to
absolutely
give
are.
people
Yeah, for sure, Brent. What do you do if you have one asset, let's say gold, in your portfolio, and let's say it were to go up to just 10,000, just boom overnight or something. So now all of a sudden it's 70% of your portfolio instead of the 10% that you'd prefer. How would you handle that?
I'd sell it.
You'd sell it, okay.
I'd sell 60% of it and keep 10.
Okay.
I mean, the people that say to me, "I'll never sell my gold." Well, if you will never sell your gold, then there's no point in buying it in the first place. The whole reason you buy it is so that you can sell it when you need it, or when you get into an emergency, or when you see some other great opportunity, right? I tell you what, if gold goes from 1,800 to 10,000, there's going to be some incredible opportunities out there outside of the gold world. So of course, I would sell some of my gold and I'd go buy some of these things that are beaten up. I'd buy something that went up 10x and I'd buy something that went down 90%.
There you go. Got it.
Yeah.
Okay, buddy, we'll leave it there. We'll let you get back to kicking butt and taking names here. For any of my viewers or listeners who want to find out more about what you do, where can they go?
Well, so, of course, your podcast, I always love coming on here. I'm pretty active on Twitter, as everybody knows. It's Santiago AU Fund. You can email me. It's brent@santiagocapital.com. santiagocapital.com has my contact information. I always tell people, people send me messages all the time. I always try to get back to people. Sometimes I get a little overloaded and it takes me a while, but if I haven't gotten back to you, send me another message. I'll do my best to get back to everybody. And of course, I'm always happy to come back and talk to you again.
Awesome, Brent. Can't wait to do it again, buddy.
Hey, if you've got a couple more minutes, there's one thing I think would be kind of fun to talk about.
For sure.
The whole milkshake theory is kind of blown up to a level that, I never anticipated, and it wasn't a plan. I was just trying to come up with a interesting way to explain my thesis to my clients, to be quite honest.
Brent, when you get done, I got to tell you, it's like a 30-second story. Remind me. Go ahead.
Okay. But, it's pretty funny. I think you know me well enough to know that I'm a pretty confident guy, but I'm not always right. I get things wrong all the time. It's why I called it the dollar milkshake theory. I didn't call it the dollar milkshake fact. It could end up being wrong. I've seen nothing yet to tell me I need to change my mind. But if I see something definitively that says, Jesus, Brent, you just got this completely wrong, I'll change my mind. I will. But it hasn't happened yet. The dollar's the same place it was a year or 2 years ago. So has my theory come true? No. But has it been disproven? No. If I see something that disproves it, then it'll become the dollar milkshake idiocracy or whatever. It didn't work. It was the dollar milkshake dumb idea. But it's never
a dumb idea, Brent, because it's grounded. Whether it happens or not, it's grounded in pure logic. So
I guess
never go that far.
Sure, but I guess my point is it's gone to a level where people just either love it or hate it. And I get stuff on Twitter. And funny, I love Twitter. If you want to send me hate on Twitter, you're not gonna. Nobody can offend me because I just won't. I will not give anybody the satisfaction of offending me. So you can say whatever you want on Twitter. It's not going to bother me one bit. You want to say I'm an idiot. You want to say I'm a moron. Fine. But I guess I would say is, for all the people that say I'm stubborn and unwilling to listen to other ideas, well, what about the people who just don't believe I'm right and just can't entertain the fact that I might be right? And I guess the point I would make is that nobody knows everything. I don't know how this is all going to play out. I think it's important to have a framework to understand how you view the world. And when your framework gets challenged, then you should challenge your thinking. And if something gets disproven on your framework, then you just need to kind of accept it. But until you get proven wrong, you got to have conviction. You got to have confidence. There is no way that you're going to survive in this business if you don't have confidence and you don't have conviction. And then you've also got to have the ability to check your ego when the time comes. And, listen, I got an ego. I mean, I'm not going to deny it, but I've had to check my ego several times in the past. And maybe there will come a day again where I got to check it again. But right now, I have a very clear view of how I think the next 2 or 3 years are going to go.
Right.
And I think that it's important to understand all different ideas. That's why I like coming on and talking to people like you. I love talking to Lynn. I love talking to Lou. I love the debate.
Mm-hmm.
I think it's important to have the debate. And I think a lot of people just take this thing so personally. I mean, it's no problem for me to disagree with somebody 1 second and go have a dinner with them the next.
Right.
It is nothing personal at all. And I think markets have become extremely emotional. And
well,
the whole world is becoming, I always say people are losing their minds. I think you got to do a very, very hard look and make sure that your emotions not getting overly involved in this. And do I fail on that sometimes? Of course I do. But I think it's important to entertain ideas that you just don't think can happen. It's when people tell me things that I think can't happen, it doesn't mean that I don't think about it. I go back and I think about it.
Mm-hmm.
You know, and I think that it's probably more important to do that now more than ever, because I think things that you just don't think are possible are going to happen over the next 2 or 3 years.
Especially with the TGA where it is, right? Maybe the next 2 or 3 months. Yeah,
it could be the next 2 or 3 weeks.
Yeah, and just on that note, I was listening to Schiff's podcast the other day, and he said some very kind things about you. The title of his podcast was kind of about the dollar milkshake theory, funny enough. But when he was kind of giving his version or why it wouldn't work, he said a lot of very kind things about you. He said, I don't agree with Brent, but he's definitely an outstanding guy. And I know you guys have been to a lot of conferences together, but that just proves the point that you could sit there as Schiff, go back and forth, go have a beer, no big deal. You get ego and emotion out of it and just try to use your brain to understand what this other person is saying so you can incorporate it into your own framework to hopefully improve it.
Absolutely. Yeah. Listen, I say it all the time. I think Peter, probably better than anybody else, is able to communicate where we're going to end up and why we're going to end up there. Mm-hmm. I disagree with him on the road we're taking to get there, but he's right where we're going to end up. I just think the timing's a little different than he does.
Yeah. So the quick story I wanted to tell you before you go here is I hired a guy, Gene, to do all my digital marketing. We improved our website. We did all these things because we're taking the content we do on YouTube, we're putting it into blog form to leverage Google search. Right. Okay. So he gives me these Google analytics, and we've seen the traffic to the website grow dramatically, like from 500 uniques to 1,000. Now we're up to 3,000 uniques per day. Great. And so I went back through it. I said, Gene, can we narrow down and find the keywords that people are searching on Google, to find how they're coming to our website, the most popular keywords people are using? So he's like, yeah, George, let me check that out really quick. So he's pop on his computer. He's like, okay, so our number one keyword for finding our website is dollar milkshake theory. I thought that was so funny. I'm like, oh, I got to tell Brent when I talk to him. He'll really get a kick out of that.
My wife and son are going to love that. They even know what the milkshake is at this point.
Yeah, you've inadvertently become a genius marketer and branding expert.
Well, we'll see how it works out. A lot of people love to send me pictures of a spilled milkshake on Twitter.
like the GIFs and stuff like that.
Yeah. Anyway, hey, it's great to talk to you again.
Likewise, we'll talk to you soon.